Welcome to the FYERS educational video series. In this video tutorial, we will introduce to you the exciting world of technical analysis. By the end of this video, you will know what is technical analysis, how is technical analysis different from fundamental analysis, and the assumptions on which the principles of technical analysis are based upon. So, let us get started by talking about what technical analysis is. Technical analysis, or TA, as it is commonly known as, is the analysis of past market action with the objective of forecasting the future price trajectory of a security. What does past market action involve? Past market action involves analyzing the historical trends of price and volume, primarily in the form of charts. The objective of a technical analyst is to identify the trend as early as possible, trade in the direction of that trend, and exit when the weight of the evidence suggests that the trend has reversed or is reversing. Let us now talk about how technical analysis is different from fundamental analysis. Keep in mind that the end objective of technical and fundamental analysis is to forecast the future price of a security. However, the approaches that are used to reach this end objective vary. Fundamental analysis, or FE, as it is commonly known as, involves studying various macro and microeconomic factors to measure the intrinsic value of a security. This intrinsic value is then compared to the market price of the security to determine whether that security is undervalued, overvalued, or is fairly valued. In contrast, technical analysis involves analyzing past price and volume data and then using that historical data to predict the future price of the security. Generally, a person who uses fundamental analysis bases his analysis on three factors. These are macroeconomic analysis, industry analysis, and company analysis. Let us now talk about each of these in a little more detail. Macroeconomic analysis involves analyzing macroeconomic variables that affect the economy and businesses as a whole. This includes analyzing data such as the GDP, currency movements, inflation rate, the trajectory of interest rates in the economy, and so on. Meanwhile, industry analysis is more specific in that it involves analyzing the competitors who are from the same industry. This is usually done by performing one or both of the Porter's 5 forces model and the SWOT analysis. Finally, company analysis is more micro in nature in that it involves analyzing the financial health of a specific company. This is done by analyzing both quantitative factors such as financial statements and qualitative factors such as speaking with the management of the company. On the other end of the spectrum, a person who uses technical analysis bases his analysis on two factors. These are price analysis and volume analysis. Let us talk about each of these in a little more detail. Price analysis involves analyzing the price trend of a security. This is primarily done by using price-based tools such as the Dow theory, Elliott wave theory, Fibonacci, harmonics, trend lines and channels, etc., as well as by using price-based indicators such as moving averages, price oscillators, momentum indicators, etc. Meanwhile, volume analysis involves analyzing the past and current volume of a security. Again, this is primarily done by using volume-based tools such as trend lines, as well as by using volume-based indicators such as moving averages, volume oscillators, etc. Technical analysis is based on a certain set of assumptions, the most important of which are price discounts everything, price moves in trends, and history repeats itself. Let us talk about each of these in a little more detail. Price discounts everything. What this means is the current price of a security reflects every possible piece of information that could possibly be discounted by market participants. The only exception to these are acts of gods such as natural calamities, which are difficult to forecast beforehand. However, even the acts of God, as and when they do occur, are quickly analyzed, interpreted, and reflected in the prices. As a technician believes that price discounts everything, all he must then do is study the price action. Price moves in trends. What this means is, price movements are not random but can be discerned into one of the three forms of trends, namely up, down, and sideways. In fact, the foremost objective of a technician is to identify the trend as early as possible and ride in the direction of that trend until the weight of the evidence suggests that the trend is reversing or has already reversed. History repeats itself. When you study past price and volume, what you are essentially studying is the human psychology in the form of various chart and price patterns. As the human psychology pertaining to emotions such as fear and greed always prevails, there is a tendency for chart and price patterns to keep occurring again and again. It is because of this that what has happened in the past keeps repeating in the future time and time again. Of course, what differs is the magnitude and the extent to which past chart and price patterns repeat in the future. As an example, the Dow theory is the oldest form of technical analysis theory that was developed in the late 1800s by Charles Dow. Despite being well over 100 years old, this theory still works as well today as it did when it was first introduced. And the reason why this theory still works has got to do with the market psychology, which is repetitive in nature. In the next video, we will introduce to you the heart and soul of technical analysis, that is charts. We will also talk about the most critical part of technical analysis, that is the trend, and about the different types of trends. If you liked our video, please click on the like button below. Also, hit the subscribe button to subscribe to our YouTube channel and the bell icon to receive regular updates. Thank you for watching this video on Introduction to Technical Analysis.